Hello, everyone. There was a big, nasty crack in the market. It was due. We knew it was coming. We didn't know what was going to trigger it, what day it was going to come. And it started on the earnings surprise by Microsoft, which gapped up the markets in a big way. And at the time, we said, what idiots would be buying up there? So the market wise, I mean, just looking at the trend of the spiders really wasn't that bad. I mean, meaning it wasn't vertical. It was getting extended from the 20, but it wasn't vertical to the upside. And there was a chance that may have happened, but it didn't. And it was the sell off. And then on the following day was the report on employment, which the Fed has been saying, what, for a couple of years employment, employment, employment. That's what they're going to be focused on. And lo and behold, they were wrong. And the number came in well below. Was it manipulated? I don't know. I guess we'll see in the future, see if there's a revision. But anyway, markets gap down. Why did they gap down on that number? Because everything changed. Now it's like there'd be no recession. We got the soft landing. Now it's going to be probably a hard landing based on that number since the Fed has not lowered interest rates. And now they're going to lower interest rates. The market, if you look at the 13-week yields, they plummeted, and so did other interest rates last week. So they're going to lower. The market's going to force them to do it. Question is, where are the big money going to be buying the dips? It's always the same. We look to the left. That pivot low right there, which is defined by a bar with three higher lows to the left or right. It could have 10 to the left and right. It's got to have a minimum of three, but we see the pivot low right there. And that's where buyers began to step up on Friday and held it in that area. Now, you can see the weekly chart. It's a big red bar. Now, red bars can be ignored, as we saw, but after you've got an extended move, look how far that is from the 20. And the 20 here is, again, equal to the 100 on the daily, which you can see my cursor on the two time frames is way down there. So that's not going to come into play. But what will likely come into play is the 50 MA, which institutions are always following. Now, there's a void here. What's a void? Well, that means that there's no support between here, here, here. There's an unfilled gap over to the left, right? There's an unfilled gap there. Could that be a downside target? Absolutely. It's too early to tell. The first level would be that 50 MA. There's nothing to the left. There's no support lined up with it. So, like, if it tests down here Monday morning, unless things move, we don't know what's going to happen, but unless things move sharply to the downside down here, which I think would be a gift if it went down that far that fast, it's more like to stabilize here. We'll see if we can get a test of the 20 MA, which I've put in this little box, and possibly could it fill the gap? If it filled the gap, it becomes a game changer because the depth of the retracement at that point would be bullish. If it's really as bearish as we see it is right now, it's not going to go that high. And it'll stay down here. And then we get the next drop somewhere, toward that 50 MA would be the first target. And then we see where it goes from there. And we take it step by step. But with a weekly reversal bar, the size of the one that we have, call it what you want, bearish, engulfing, piercing, big, ugly red bar, it suggests it's going to go lower. And look, maybe that 600 area, which is lined up with this larger congestion area, would be an excellent place to be looking for longs, somewhere down here where I marked it off with this relatively large area in the gap. Your next major support level, way down here, that pivot low. Notice there's no pivots. When there's no pivots, that means there was momentum, and the probability is that there's a big old void there. So S&P spiders here. First level would be this pivot low. Second would be the 50 MA. And the third would be somewhere down here. Game changer if we get a deep retracement back up again. We got to have two scenarios. The Qs will be a focal point. And so what I've marked here is what do institutions look for as a reasonable correction in a bull market, 3 to 5%. Downside 5% would be around the 50 MA on the Qs here. There's nothing to the left. It could overshoot it a bit. You got this 540. Got the same unfilled gap down here. But for Monday morning, this pivot low, the support area where it stabilized is our first reference point. And we'll be looking at this pre-market tomorrow morning at 9 o'clock when we do our pre-market review to look at what the intradays are doing, what happened overnight. Again, the weekly big reversal bar. We're also going to be looking in the coming days at our market internals, which guide us as to where the markets have reached an extreme based on what's happening with sentiment, these put-call ratios, and breadth. Now, breadth was deteriorating for the longest time, I guess almost 2 months, while the market was advancing. Historically, that's not a good sign, but you can't fight the trend. It was going higher, and that's why I say we knew this was coming. We just don't know the day, right? But historically, when breadth is deteriorating like this, right, what's going on under the hood, and the market continues higher, and sentiment stayed relatively high like that, it suggests that institutions are in denial as to what's going on. And so now we've got this beginning of a correction. We'll see if it stops at the 50. 6,000 would be an obvious place, and it would be aligned with all of that congestion. So we'll see how that plays out. Of course, take a look at semiconductors because they have been the strongest. Where you see they popped up above the high. They violated both of those pivot lows. They didn't do it on a closing basis, but you've got a crack in the armor of the strongest sector, and it did pop up and make a new high. So everything is set up for prices to move lower. In addition, you got the transports, which really fell badly to the downside. So we look for more sectors that are in alignment, giving us the same signals because that increases the probability of that working out. As it suggests, mid caps broke down. If you look around, you could look at other things, regional banks, the way they broke down. So these sectors that have fallen as far as they have early on are the ones that are likely to fall less, and the stronger ones like technology are the ones that are likely to get hit harder. Right? In any event, we're looking for more downside rallies to get sold into, and then the cycle starts all over again where our internals line up, and we look for higher time frames like the weekly, which have been strong, to then get bought, make a higher low, wherever that's going to happen, and present us with new buying opportunities. As always, if you have questions, email us